And good morning.
What's brewing, Austin, Texas? Cooper Goodman getting ready. He's got his 4th of July bandana on. He is celebrating and ready to go bark at every time the fireworks go off. It should be entertaining.
He's a patriot. I love him.
Cooper Goodman, patriot. Born in the USA.
Born in the USA. He doesn't like, I don't think there's any dogs that like when fireworks go off. I've never really have experienced a dog being like, yes, let's blow shit up. I love to blow shit up, but that's the boy in me. That's the boy in me.
I love watching it.
Yeah. Where are you going to watch him?
Well, that's a good question. We have 2 invitations right now. Actually, our client invited us over.
There you go.
That we recently closed on. And so we may go over there or we may go downtown and watch it like from closer to the lake. So either way. What about you? What are you doing? Oh, and I've got pancakes. I forgot about pancakes.
What does that have to do with
4th of July pancakes? I don't know. It's going to be we're making it a thing.
Oh, all right. Well, hey, there you go. Last year I parked at Lifetime downtown and then I just walked over. I'm close enough. I'll probably just bike, hop on one of these bridges, watch it blow up, and bike out of there. I'm not a traffic guy. I don't want any.
Do you still have your secret parking spot though?
Yeah, you can just the Lifetime gym. You can just park in their garage. Given that I'm a member there, so.
Oh.
Yeah, you park there and you walk down. It's right across from Whole Foods. So I mean, you simply walk down. You're on the Lamar Bridge and. It's a great spot.
You're right there. Yeah.
Mm-hmm. Yeah. I'm not traffic, so getting super close or anything like that. So for me, it'll be, I'll do it all on bike this year.
There you go. Love it.
Yeah. So we are here to talk about what is going on in the Austin market, as well as what is going on in the economy.
What is brewing in the economy today, Kevin Weedmark?
Yeah, we didn't get some good news. I said it to I had 3 conversations with clients yesterday over locking, and I basically said there was 3 outcomes that could happen this morning. And it was all relying on that jobs report that came out this morning. So we saw a Nonfarm payrolls jump significantly. If I add this to the stage, this is all the data that came out. If you go right to where it says non-farm payrolls, it's about the 127th down. You can see it says 147,000. They were estimating 111. That's not good for interest rates. So, because what everyone's wanting to see happen for interest rates to improve is a sluggish economy. If employers are adding employment, that means people are securing jobs, which is great, right? It's a good thing. But from an interest rate perspective, it's not so good because it doesn't really give the Fed any ammunition to lower the Fed funds rate, given that inflation is still a concern. And now all eyes will go back to that with CPI next week and the passage of this big, beautiful bill. So basically the 3 things that could have happened is, if unemployment came in low today, you would have saw an improvement in rates. I thought even if it came in flat, rates would go up a little bit. And now that we've seen a significant number, this was, let me see here. This was so this is your 10-year treasury. This is what directly correlates to interest rates, almost a direct correlation. There's a few ticks that are off, but this is what people actually look at in my world. This was pre-release, and then this was after. So we swung almost a whole percentage point, a 0.1% since the release of that data and what interest rates do. And to give everyone an idea, and hopefully I'm not losing you, Jennifer Goodman.
Well, I love that you assumed I could read the chart. So that just put me in my happy spot because I can't see a damn thing. Yeah. So I'm going to trust in Kevin. We trust.
In Kevin, we trust.
Kevin.
Well, yeah. I mean, if you look at this chart right here, it's a negative. That means rates are getting better. Rates are going to improve, right? It's coming down. Its ticks are coming down. If you add that, all of a sudden the unemployment got released, the non-farm payroll, we see it up. That means rates are getting worse. So it's just a direct correlation. So it's, and
So
what
when
we
you say
see,
the rates come down, are you talking like, so just for our viewers on our
yeah,
own podcast, when we talk about rates, can we start breaking down the Fed fund rate and say Fed fund rates and then say mortgage rates? Because for me, I'm like, what's coming down? Like the Fed fund rate, which is tied to the 10-year treasury, or sorry, mortgage rates are tied to the 10-year treasury. Like, how do we break it down going forward? That's all.
yeah, no, I think it's a great question. And essentially what you're looking at is depending on when, well, here, I got another chart that I, you know
Oh,
what?
wait, hold on.
What?
You said that's a great question.
Oh, it is a great, it is a great question. Let's see. All right. If I open this one and I present this one, okay. So this is essentially what happens with the 10-year treasury is there's a spread. You see the spread over to the right. And what banks are doing, the Fed funds rate is what banks exchange money at and what banks can borrow money from the Federal Reserve at. So that's what they're paying. We don't get that rate, right? Because we're higher risk. Once you start involving people, money, situations, family, loss of jobs, you add risk. There's risk levels to that. So what this shows right here is over to the right, you see a typical spread. The typical spread is anywhere from about 1.5 to 2.5. So what that means, you would add 1.5 to 2.5 to this number right here, the 4.342. So let's just say you added 2.5. That means that you're going to see published potential rates, and everybody's rate is different because of their credit score, how much they're putting down, and there's all these variables. But for general rule of thumb, right now we're operating at 2.5 over, as you can see from that chart that I put up right here. Mid 2025, we're running at a spread of about 2.5. And the reason that is just because it's extremely volatile, it's high risk, rates are high right now, default levels could be up. There's just so much out there that lenders are saying, nah, we need to pad it just in case something drastic happens, that we're safe. So that's what they do. So if you look at this chart right now and you add 4.3 to the 2.5, you're sitting at essentially this chart that I showed you. It's a great example. 4.3, 6.8. That's going to be the rate that you're going to see that's going to be published out to the public. And that's really why when you look at that 10-year treasury, you see that interest rates move. It's not a drastic movement. It's not like it went from 6.25 today to 6.8. But as you can see, it's trending upwards. And as we move closer to that 7% range, it just creates a little bit of quicksand because we just cannot seem to consistently get off.
So it's like so all over the place. It's like I have that song Popcorn in my head from back in the day in the 70s. That song do 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 do. Or Super Mario, where it's just like, you know, you're waiting for the right.
Yeah.
So we hit a 6-month low last week, correct?
Correct. We bounced on it. Yep, that's correct.
And now we have kind of literally bounced, and we're higher than we were at that 6-month low. So for those who didn't lock in, I guess they're hopefully waiting for, news of Trump adding, a Powell an instigator for the Federal Reserve chair, and like they're waiting for another hopeful.
Yeah,
I don't know. Like what am I? Like what I'm hearing is so confusing as a buyer, and that there's these tight windows of like lock. So like, what is your feeling right now for, let's play it off of somebody who has a closing in the next 45 days?
Mm-hmm. And the reason why, like a lot of us in this industry would be like lock, because we see firsthand the peaks and the valleys. They're
Right.
not significant, but because everyone is so interest rate driven, that of course we add an element of, oh my gosh, like right now's the time. In reality, you're talking maybe an eighth in interest rate, maybe a quarter at best. So
Yeah.
it's not crazy. And if I pull up that chart that I just wanted to show you, like you said, where is it? Did you take it away? You took it away. What?
It was a Calgon moment.
So, hey, here it is right here. This is the 6 month. You said 6 months. Like, as you can see, we were just at like 4.25 over here. If you go all the way to right before this pop this morning,
Yeah.
you're right. We were right around all the way back to March of last year. In April, that was the big dip when he came out with the big chart with the tariffs.
Yeah.
That's what it was. But people in our industry add a little bit to it, and everyone in the industry is trying to draw people in as well, right? We're trying to almost like I don't want to say car salesman, but we're trying to say, hey, interest rates are lower, make a move, because we're trying to get people off the fence. And it's not that it's drastic movements; it's just a lot of these peaks and valleys, and you just have to navigate. So, what I think over the next 45 days. Right now, there's a 95% chance that the Fed is going to do a September rate cut. That's what everyone's thinking. It's going to be really interesting to see what that number is after this morning's news. I think that's going to change. But the market's forward thinking. They've already built that in. So in all honesty, at this point, seeing that number and knowing that inflation's been creeping a little bit up, I'm more pessimistic at this point than I was 3 weeks ago. I think interest rates are going to hover in this quarter point from 6.75 to 7%. I don't think we're not going to see much relief.
Yeah. I mean, at one point we were actually talking about the possibility of a July rate cut. That was like in the purview, but it sounds like that's.
Well, that was last week. We had Fed members coming out. We talked about it last week on last week's show.
How many? Like 8 members spoke or something, and it.
Well, 3 of them actually come out and publicly were like, "Hey, I think July is going to be the right time."
Wow.
And I'm pretty sure that their music has changed this morning, and it's simply because inflation isn't. Bless you.
Thank you.
Bless you. Inflation's not raging. But it's ticking up, and now that you have a healthy job market coming back as well, it leaves little room for the Fed to get off the fence. They don't need to. If the economy is healthy, their concern now turns back to, well, shit, we can't decrease the Fed funds rate because we're just going to further fuel inflation.
Yeah.
And we're signing this big beautiful bill, which I'm not a fan of.
You're not a fan of the big beautiful bill?
I'm not. I think the overall what they're trying to do, I like, but I just think adding all this money to the federal deficit is just going to be more short-term pain.
Do you think, Kevin, that they're trying to really crash the dollar and really move us more toward the gold and silver standards and then into Bitcoin? I mean, because this is certainly the way to do it.
I think they want to lean more on that. I don't think that that's necessarily what they're trying to do. I think it's the classic political, let's spend our way out of the problem that we're in. I mean, look, that's how.
Look where that got us.
Well, that's how you get to $37 trillion in debt. Like you keep saying, okay, it's going to increase it, but it's going to give tax relief. That tax relief is going to spur growth. I mean, that's going to be the justification today. The justification you're going to hear from that side is like, hey, the economy's going well. People are seeing that we need lower interest rates. People are going to, jobs are healthy. Like we need to give these tax breaks. It's what's keeping the economy running. Unemployment dropped to 4 point. I mean, that's going to be all the mantra today.
Yeah.
But at the end of the day, if you run the federal deficit up to $40 trillion, that's a problem.
For sure.
The numbers still don't work. So I'm just kind of like, okay. And the belief is that the jobs will create more taxes and taxes will pay down the federal deficit. We continue to find waste. We'll drive that down. Energy costs will come down. And I get the long term what you're saying, but I also look at history and I know what I know, and I'm like,
Yeah.
I'm not a big fan.
Fair enough. Well,
Yeah,
when we look at, sorry, go ahead.
no, there's just too much fat and bullshit in government. It's awful. It's all this, like the fact that you have to have 1,000-page document to pass a bill. It's wild. Like what?
Well, there's so much that's tied to it, right?
That doesn't need to be. That has no bearing on us as the American people as a whole. It has a lot of these senators and house members looking at it as a whole and then saying, well, what's best for Tennesseans? What's best for Texans? And they add all this bullshit little, like, give me, this money over here so we can do this bridge and do this and do that. And I want this and my people and all of us as a collective whole are paying for all these programs and crap that it not doesn't affect me, you. I mean, and it's why we're where we are.
Yeah, I mean, but the goal is, my understanding of the big beautiful bill is, I mean, it's a comprehensive piece of legislation. It's not. By design, it's going to be big, and we're really looking at tax cuts in the Jobs Act, right? So, if they're looking to deliver tax relief, then there's obviously going to be a ton of confusion. And also, and I did a short piece on this, is like there's a ton of opportunity too. So, I mean, there's the economics growth initiative. There's border security tied to it. There's welfare reform tied to it.
Yeah.
So there's a ton of stuff. So, I mean, the big beautiful bill is an overhaul of federal policy. So I don't think they can make it small. The question is, to your point, is what the padding is, how it handles certain things, like, there's border security and national defense, and there's so many things in there. What I look at it for really is, what you look at it for, I think, in our industry, what we're caring about are what are some of the tax incentives for our investors? Where are people where is the everyday person able to hang on to their money? How can they invest and get returns? I mean, you've got builders right now sitting on the sidelines because the cost of borrowing is too high. You've got a lot of people who years ago were screaming, houses are too expensive, I'm not buying, I'm waiting for the prices to come down. And those people are still sitting because now the prices have come down, especially here in Austin. And they're still like, oh, I'm going to wait for them to fall further. And I think, will they? Yeah, I mean, I think we can dive into some numbers on that coming up. But the big beautiful bill itself, I'm really looking at, like, how does that work for my investor clients, right? Where are the tax incentives? What can they write off? What can homeowners write off? And there's like so much tied to it. So 1,000 pages is.
I mean, they increased what do they call it? The SALT.
The SALT
from
from 10,000 to 40,000.
So there are some significant stuff. Where I get lost is, you're trying to piece this and they don't know either, is my point. Like, you just laid out how many things, right? Why not just take each of those and do a bill for border security? Done. Yeah. Do a bill for this. Done. Do a bill for this. They don't. They hodgepodge it all together, and then it leaves everybody kind of like, I don't know. And you got this side telling me that the world's going to be wonderful in 6 months from now, and then you got all the naysayers saying that you got 17 million people that are going to lose healthcare. And I'm like, well, how many of those 17 million are actual, citizens and all, you start getting into all those weeds, and it's just like, just pass something for what it is. So, I think there's going to be some benefits for sure. I think there's going to be some tax incentives for sure.
Yep.
However, I just think from an interest rate perspective, we're not going to see what we were hoping, or I was hoping, and I was predicting for the near future. Given this number. Now, could it change next month? It absolutely could. But I think today was a shock to the system of where we were perceiving we were and where we are. And then, just on top of that, we talk about, to just bring it back to real estate really quick. I pulled this. Oh, no, I want this one. I want to remove that. There you go. This is basically a chart of the percentage of people. That's interest rates. There's 21% of homeowners out there that have rates below 3%. There's
That's
34%.
1 in 5 homeowners in the nation has sorry, I'm going to start over. Start over. 1 in 5 homeowners has a mortgage rate of under 3%.
Over
today.
50%, over 50 or below 4.
Right.
60% are under 5. And then you're basically talking, you only have 17% that are above 6.
Wow.
You have 80% of the market locked in. 83%. 83% of homeowners are locked in below 6%. I mean, that's staggering.
It is.
So, when you look at it and you're trying to get movement in a real estate marketing, you want to get traction, and you're wondering why all these people are preaching like, hey, there's going to be, there's not enough inventory. There's not this, there's not that. Well, if you look at it from a home builder's perspective, you're like, well, shit. I mean, you have over 50% of the people that are going to have to walk away from a rate of 4 to go to 7 potentially. Yep. And, what does that look like? I mean, how many can you draw? How many people really need to move as opposed to want to and give up that rate? So, looking at it from our side, and let's really dive into real estate, you can see why some markets are sluggish, right? I mean, the numbers don't lie. They're right there. The numbers
don't lie. That's what I said yesterday in my on my run, talking about data. And both personal feedback data, like if the number on the scale is going up, number of the scale is going up, and for that one, there's no interpretation, but the data can be spun in any number of ways. And I think that there's a huge opportunity if you're out there as a buyer and a seller to really get with somebody like Kevin who understands the data, not the national data. The national data is great. Don't get me wrong. But what we're looking at, if you're living in Austin, is what is the data as it pertains to the city? What is it? Is it Hayes County? Is it Comal? Is it Bastrop? Is it Travis? Is it Williamson? Like what county? And then let's start looking at what part of the city you want to live in for your tax rate. What are your insurance rates? Like all of these things come into play in understanding what you are creating in a move, because all of those things, not just one of them, not just the rate of purchasing, needs to be considered. Because you guess what? You're paying taxes every month and you're paying insurance every month. And that's reality.
I agreed 100%.
Yeah.
I'm trying to run a number right now. I want to do this really quick, but you can keep talking. I'm
thank you for letting me talk.
You know what? I take it back. I'm going to take the floor. No, teasing. Let's see. If I do this real quick, so if I go 632, you can kind of fill in here if you need to. I'm
going to share my screen.
Oh, all right. I was ready. I just got ready.
Awesome. We're going to come back to you. So can you see this right now for the city of Austin?
Yeah.
And our monthly sales prices. So now I track, I'm not showing you my screen right now, but these are not the final numbers. And there we go. So looking at these numbers, what I know in my tracking, which I've been doing for a few years now, needless to say, and if I break down just this week, so you're looking at the monthly chart right now, but if I break down just this week, we just hit 48% of homes for sale in the Austin MSA as being under $500,000, 48%. So that, and the other numbers stay in line. So I don't really tread a lot in that price point. But what I am looking at is the continuity that exists inside the $1 million to $2 million, which is 10.9%. So almost 11%. One in 10 houses in Austin right now that are currently for sale are between 1 and 2 million. Okay, so that's to me is fascinating, because right above that is the fact that 12% of all homes for sale right now are 750,000 to 999. So that's a pretty powerful number, because we've hit, when you add condos into the market, we've got over 17,565 homes for sale. Now that is kind of a bit of a record-breaking moment for where we are in Austin. Did my screen just disappear? Let me see. Here we go.
No, you're
So,
here.
but what I want to do is look at the median sales price. So here we are at 586. So we're only down 0.7%, not 1% from the previous year. When you look at June. Now, again, these aren't the final June numbers. We don't have like the last week in here. But what this does is, most importantly, I want to take a look at where we are trending in 2025. And it's showing that we are below 2024 and below 2023 in our June numbers. So that's a pretty, like, that's, 608 versus 586. That's real money in pocket for what you're going to get for your house. But this is not 2008. This is like the level of equity that people have in their homes today far surpasses. And so it drives me mental when people make those comparisons, because we don't have the houses that are being foreclosed on like we did. Are we seeing foreclosures go up in the nation? Yes. Why? Because for 2+ years, you couldn't foreclose during the whole pandemic. And so because they put a halt on that, of course, you're going to start to see those numbers come up, because people who didn't dig themselves out then and aren't digging themselves out now obviously owe the money, and they're going to start seeing the pre-foreclosure numbers continue to go up, and the foreclosure numbers, as they've lost the opportunity with forbearance and all of the things that we previously had. So I think that there's a huge opportunity inside of Austin right now. And if you look at those numbers, let me go back to sharing that screen again. Little musical interlude. You can see, as we go through the year, hitting July, as we go through the year, what happens? Continuous-ish trend. Last year we had a leveling off, so this was like a good news scenario. And I'm not showing the 10-year or the 20-year, but historically what we do is we start to do some of this as values go down. Now, quantity is also going to drive this number, of course, as it pertains. Thanks for switching that up. As it pertains to the numbers, but this is not news. The sky is not falling. We are as far as I am concerned, we are in a market correction. This is not a market collapse. It is a market correction. And I think you're going to find most people that you talk to out there, maybe even yourself, including Kevin, is that this is really, truly a correction, not a crash. What are your thoughts on that, especially as it pertains to Austin?
Yeah, I mean, look, I think what's really preventing a crash is the lower interest rates we just talked about. I think
Yep.
if you're sitting at 4 or 3%, you can't go rent anything that's cheaper. So you're going to do all means possible to make that payment. And I think that while it takes away the volume, it creates a nice cushion, so to speak, and a nice buffer that we're not going to see a crash. Those days are not coming. The economy looks healthy. The labor market, there are people that are hiring. JOLTS had a ton of job openings when that report came out on Tuesday. Like that is not in the foreseeable future. And shelter is your biggest payment, as well as the one that you have to make. Like you will eat ramen to have a roof over your head. Like it's not the other way around, where you're going to go get the tomahawk steak and then sleep in a tent. So, those lower rates, I agree with you. I think it adds some stability, and it prevents, It prevents this crash that everyone thinks is going to happen. It's just not.
Yeah. So continuing on that line, I would like right now, I would say Texas real estate still worth it, or is it time to bail?
I mean, Texas overall, I think Texas overall is extremely healthy. It still has a huge tax benefit for corporations. Corporations bring employees, employees spend money.
Yeah.
As far as Austin in particular, it still has an amazing appeal because it has just so much to offer from a lifestyle standpoint. So as long as they continue, which they are, and we've talked about this before, invest money in infrastructure and grow the city out, they are going to need to incentivize businesses to come here. Otherwise, that's a loss. So what's going to happen is if they find they're not attracting the businesses they need to, they will begin to alter their offers and they will bring the companies here. So the long-term trajectory for Austin is great. And like I said, the city just has a lot to offer from a lifestyle. The food scene is awesome. You can get on water very easily at all different levels, boats to paddle boards, the skylines behind you. I mean, you can get out on big ass lakes and do big boats that are an hour and a half from here. You have that from a cycling standpoint. It seems to be a bike friendly city. So you have that. The only real lacking that it has, and I think the other thing I think I really like about it now is Austin is very centrally located. So if you want to be near downtown or you go downtown, it isn't like you have to go to pockets like big cities. Like, oh, we're going to drive over here to, Bishop Arts up in Dallas. Well, now I want to be downtown. I got to jump back in a car. I got to drive 20,
45
30
minutes. Yeah.
Yeah, that's not Austin. You can drive your ass downtown. It's 5 miles wide. You got Congress is the south side. Jump on a line, and you could be all over the city. So it's got that huge appeal. The only thing we miss is public transportation. If that's really your thing, yeah, we don't have that, but we have the climate that's conducive. As long as you don't mind sweating, you don't. It's not like you're going to freeze your ass off. You might be sweaty as opposed to frozen to get to where you want to go. But I'd rather be sweaty than frozen. So you can get around it 12 months a year. Like there's no excuse to not be able to get from point A to point B, where when you're dealing with that in Chicago or New York City, you're talking frostbite. I mean, it is critical for your health to not be outside.
Yeah. So Austin just launched. Well, let's start over. Tesla just launched their new ride program, if you will. And for like $4.10, you can get in a driverless car and go just about anywhere. So we now have two we are like the playground for these driverless companies because we've got Waymo and now we've got Tesla. And so your ability to not get hot and sweaty and to take these driverless cars now just about anywhere you want to go is real. And for $4.10,
that's crazy.
It's going to change.
How do you do that? Sorry, how do you do that? Like, where are you getting? Like, is it is it an app? Is it Uber? Like, is it a private?
You know
app?
what? I have no idea. I haven't looked into it yet. I'll be honest.
Come on,
with you.
Goodman. Oh, sorry.
I can look into that for us and report back.
Yeah,
but
you can't be you can get.
I mean, we've also got that robot. Have you seen any? Have you seen that robot? That there's multiple robots walking around downtown now with cowboy hats on and stuff, and their movements are so lifelike. It's like the interpretation.
Yeah,
it's crazy. We're not far from Terminator world, I'm sure. But I wanted to go back and talk about, Texas as a whole used to be the gold standard for real estate investing. I mean, let's face it. And we're facing rising insurance premiums, higher property taxes. and some lingering effects of overbuilding during the pandemic. So the state itself boasts like massive migration effects, which is fine and dandy. I think it's important. We still have solid migration numbers. We've talked about that on other episodes. Austin only had, I think, 0.6 growth last year. So it's the flattest we've been, where DFW, Houston, and San Antonio all saw a significant increase. But I think, we're not immune to the economic pressure, just like any other state is. And I think that if we look at Austin, DFW, Houston, and San Antonio, each of those markets are going to reveal a different sort of truth behind the headline and different nuances on why your local strategy truly matters. So I think you brought up some really good points for why Austin. But when we look at it from an investor standpoint right now, our home prices overall are down about 6% year over year, which is one of the steepest declines in the US for any state. We also had the highest trajectory when the pandemic hit. So what goes up must come down, as they say, but we're still above our pre-pandemic prices. Our rental markets, if you are in the business of owning apartments in the country right now, it's one of the hardest markets to be in for rental market. Our inventory, obviously, way up at about 60% since pre-pandemic, which obviously puts a lot of downward pressure on pricing, both in the commercial space and in the residential space. Days on market, as we know, has climbed, depending on what zip code you're looking in. It could be 50 days, it could be 75 days, even longer, depending on where you're looking. What else is Austin seeing? Our jobs, which you talked about earlier, Kevin, like our jobs market with the tech layoffs right now, and hiring freezes is definitely impacting demand for not only work, but housing. And this ADU thing in the residential space, while we got this amazing approved policy, it's really hard to implement, as you know, because we've talked about investment properties, we've talked to different investors, and you still have these setbacks. You can't get around them. So it's tough for investors right now, and I think a lot of them are waiting for further price declines and pressure of lending rates coming down and tariffs and all the things.
You made a great point. I think a lot of it is the setbacks. That's number 2 today for you. Let's not get carried away.
2-1, it's close. It's close.
The setbacks are a real problem. I almost think they did not think of that with these ADUs and, you can put all these properties and create density. I mean, again, I think it's the city council's not the sharpest tool in the shed. Like they're just not. So I think that's a problem. And then the other thing, it's just the labor side, right? So you've had such a drastic increase in living. In post-pandemic, we just had such a rapid run-up of values for houses. A lot of these laborers just were like, well, I should be getting paid this per hour. I should be getting paid this. We have not seen the correction from a labor side to match the stabilization that we've seen in housing. Right. We've seen a little bit of a correction in housing. We have not seen a correction in the labor market. So unless you're at scale, it's very difficult to make the numbers work. And that's why you're seeing a little bit of a bottleneck in, you said, the investor side, because it's very difficult with the days on market to make those numbers work. It's difficult. Obviously interest rates play into it. But at the end of the day, if numbers work, numbers work. If rates came down, would it open up some doors? I still think the biggest problem in that sector at the moment is the labor market. I think it's a lot higher than it could be because, as you know, I got my company up in Michigan. I'll argue all day long that those workers are 80% of them, it's an 80-20. They are more skilled in their craft than they are here in Texas. and labor's cheaper there.
Wow.
Yeah, it's
Yeah.
it's crazy. Yeah. And in
Yeah.
Austin in particular, right? It's Austin. It's awesome because it's a little bit more expensive. It's a high demand city from that kind of culture standpoint. So Austin in particular, I think, is why, the labor side is what is causing a lot of the investment side to struggle here
Yeah.
in particular. So
Yeah. I mean, and we are kind of this double edge. Like we've got, the Google building, as people call it, which is, how many hundreds of thousands of square feet of space did Google not end up filling? But now it's slowly getting filled up with other leases. But I mean, the history of this city continues to be high on the desirable list. And so when you compare it to, say, a Dallas or, and the numbers that are happening in San Antonio or Houston, and what's happening, like statewide, I think we're doing really well. Like statewide, we're only down 1.9% year over year in price drops, like for homes. That's like that compared to other places. It's like we're well below the national average in that side of things. But again, we have to look at insurance and taxes. I'd take us over Florida all day, every day, and twice on Sundays. I would take us from a national disaster risk over Dallas because we don't get the tornadoes like they do. We don't get the flooding like they do in Houston. So there's that. Our builders though obviously get paid a whole lot more to build here than they do in those other markets. Multifamily, I think, is, we even with the migration that we have coming here, as an owner of multifamily, Texas is not the best place to buy right now if you're looking for cash flow. There's so many other markets, and if you are looking for multifamily and you want to talk, and that multifamily is under 12 units, then let's talk about it. But if it's bigger, then you're still looking at tertiary markets, and I'm happy to set you up with people, but I'm telling you, Austin is probably not the place to do it unless you've got deep pockets. You can buy bigger at a more sort of depressed price right now, and you've got the infrastructure to now change the class of that building over and add value to your tenants.
yeah. It's a little tricky, right? It's a little tricky right now, but like you said, there's opportunity everywhere. I mean, if you're actually an investor, the opportunity is there's not a lot of people buying shit.
Yeah, absolutely.
And so, if you're using your own money, that's an advantage, right? You don't need a loan. You're not having to pay interest on that money. That's a game changer.
Huge right now.
And if you're able to, the other side of that also is huge, is not only using the money for the repairs and using your own capital, right? There's a loss because you could be making money, but at the end of the day, you're not paying. You can offer cash for a lot of these places, and who knows what somebody's situation is. Hey, I'll close in a week. Here's my offer. So there's always opportunity. It's a matter of, we talk about it a lot. It's being strategic, knowing your advantages, knowing your situation, knowing how to position yourself correctly, knowing the numbers, so that on the flip side, you're not going to, you're mitigating your losses, your potential losses. You're making sure that, hey, if it winds up being a break even, lesson learned, or okay, that's the way that the cookie crumbles, but you definitely don't want to position yourself for a potential loss.
Agreed. I mean, Austin as a whole is still growing.
Mm-hmm.
Excuse me. Austin is still growing. It's just no longer an easy yes.
Yeah.
And it once was. And so for homeowners as well as investors, the math has to work on your own personal or micro level. And so that also plays into your school zones, your operating costs, disaster, risk that we talked about, and then the shifting migration patterns. Austin overall, in 5 years from now, where people are going to look back and be like, damn, I wish I bought. Damn, I wish I bought. I thought it was high then, but I wish I bought. I thought And people say that about how many things, right? Like whether it's the stock market or your crypto portfolio or whatever. I wish I bought.
Everything tends to go up over
Everything.
time.
It will. And again, to your point, if history is the indicator, then I think we've got, I'm bullish, not because of anything other than I'm just watching and watching and watching how the city is growing, how we're adding infrastructure, how our little town is kind of growing into a city, in my opinion. And, you know, we do have enough homes for sale right now that are under $500,000. Austin Habitat for Humanity actually expanded their access with income limits now. So they've got, as the Austin home prices continue to climb, past the $528,000 mark, more of the city's middle income workforce is being priced out of the home ownership. And so what Habitat for Humanity is doing, they're actually expanding their affordability home ownership program here in Austin to keep up with the reality, which kudos to them. Way to go, Habitat. And it's really cool. They've raised the income limits. So more like the more traditional wage owners are like our teachers, our police officers, our healthcare workers, to help them qualify for homes that are priced below market. And I think that is awesome, because as we saw earlier, our average home price in Austin is up. I think Zillow has it at around 528. But as we saw earlier, if it's in Austin proper, you're closer to the 565-ish mark. And essential workers are getting locked out of home ownership, and that sucks. And so I love that they added an opportunity more in this sort of starter home. And so they've given these new HUD adjusted maximum income limits for people to buy, but they've upped them in a way that I think, will it matter? I don't know. For like a one person household, the maximum used to be $68,500, and now it's $72,950. If it's a two person household, it used to be $78,250. It's now $83,000. And then it continues to go up. So if you've got like a 4-person household, this is the first time they've considered, when you're making more than 6 figures, that you can be part of that program, which I think is super cool. And again, kudos to Habitat for Humanity. I love that they are adding to Austin's affordability for people who support all of us when we need them most. So wanted to just throw that in there.
Yeah, Texas is pretty proactive in that. They got a Texas Homes for Heroes program as well.
Yep.
Very similar. Firefighters, whoever, and
military.
Obviously all of those limits keep increasing because the cost of living continues to go up. So kudos to them to be able to have the foresight and get it approved. I mean, that's the other hurdle, right? Is the approval side of it. It's great to say, hey, the cost of living went up 10%, but to then correlate that to the other side is the difficult part. So.
Absolutely. And it gets people out of the renting and into home ownership. It hopefully gets people who are, maybe once upon a time, if they tried years ago, they were burned out on bidding wars. And so they just want to get that foot in the door. So I think it's awesome that they've offered this. And to your point that we do have other programs. So if you are considering buying at this time, then talk to Kevin, because he has access to all sorts of programs in ownership, and he'd be happy to help you out.
Yeah. Again, I love talking scenarios. There's always different angles, and look at it 1,000 different ways to see how it can make sense, for sure.
Yeah.
So
Kevin, let's where do we want to go next?
So, I mean, my things I said I wanted to talk about were, okay, we were sitting pretty on an 11-day rally that ended yesterday with interest rates coming down. And as we already talked about, it wasn't drastic movements, but we had an 11-day rally. And I talk a lot about ride out the peaks, lock in the valleys, right? So that's where that comes in. I had non-farm payrolls are going to determine the next 3 months. We saw that non-farm payrolls exceeded their number today. So as I've already said, I think that kind of locks us into this window of high 6s to 7%. Now, everybody's situation is different. Even though you see rates at 7%, you might be able to get into the mid 6s depending on how much you're putting down, your credit score, loan program. So always make a call to an expert, somebody in the industry, and make a couple, because you're going to get a couple different analysis. So don't always go by the national headlines that Jennifer always says we don't want to do. I think this big, beautiful bill over time could be something that keeps inflation high, which is why I don't have a great outlook at the moment now, combined with the payrolls for the next couple months. And in speaking, we were at a 95% chance this morning, before that data came out, for a September rate cut for the Fed funds rate. That's now sunk to 77% just because of this morning. So
Wow.
as you can see, yeah, we are at 20 percentage points just already swung, saying, hey, maybe they're not going to cut. So interesting. We can definitely paint the picture of July, and why that's changing is, should we now next month get good numbers as well on the non-farm payroll, and we continue to see inflation tick up, you will see that absolutely change, and we will not be getting a September cut. I've been saying since January, September was when it was coming, because I thought that the economy would be sluggish. But today's numbers are interesting. It's not what I expected. I can tell you that. So I think that's, and I don't mean to be bleak. There's always opportunity. We've been riding in this range for all of 2025. So to get discouraged at this point, like, there's nothing discouraging about it. You're asking my opinion, and that's what I think it is. But I think the long term, like you said, I think the long-term outlook for the Austin market is great. I think short term, you got to be really careful. And I still think we are in this rate reduction area. I think the Fed is still motivated to get the Fed funds rate close to the inflation target of 2%. That is their goal, to have stabilization. There's just too many variables currently at play where this unemployment number isn't drastic. It's 147,000. It's not like it's a number that came out like 300,000. Oh my God, the U.S. economy is on steroids. No, it's not. 147,000 for our population ain't shit. I mean, if you really look at it, the problem is you're layering on inflation. You're layering on this big, beautiful bill. You're layering on tariffs. You have all these other variables. So I wouldn't get totally discouraged by the number. It's one of those things, right? Traders are forward thinking. They're now looking from a Fed's perspective. It just doesn't give the Fed any ammunition to be like, we need to make a move now.
Yeah.
They can sit tight and not do a damn thing. And then you have, on the other flip side of it, now that you asked me all these questions, you have the political posturing of Powell. Powell doesn't want to go out and leave his legacy that, he's the one that decreased the Fed funds rate, led us to stagflation, all of a sudden derailed where we were headed with pulling inflation back in. Like, for him to just sit tight right off into the sunset and said, I did all I could in an extremely volatile time with this tariff war, with a $37 trillion. I mean, you have that element as well. I mean, there's just no. So it kind of just, to me, it pigeonholes, and we're going to be sitting now for probably the next 3 months till we get some more data that could either conclusively send it one way or the other. Because 1 month we're here, then 1 month we're here, then 1 month we're here, and 1 month we're here, and we see the interest rates switching about maybe 1/4 to 3/8 at best movement. That's it. That's where we've been hanging.
Okay.
So.
Wow. Okay, so let's move to our fun fact.
Wow. You really digest. You were like, okay, he's
I'm
done
just like,
talking.
I'm
Wow.
on wow. I'm on wow. All right, you ready? You like a quiz, Kevin?
Oh boy.
Here's
All
the
right, go.
quiz. How many places in the United States are
10.
named Austin across various states?
How many places? Like you talking like
In the United
restaurants?
States are named Austin across various states.
Jesus.
Jesus is not a number, Kevin.
I'm gonna say 2,500.
2,500 places in the United States named Austin. You are close. The answer is 22.
Ooh.
Of course, our Austin, Texas being the most well known. But there are 22 Austins in the United States.
Wow.
Now, some of them are like unincorporated. There's unincorporated communities or census designated places, but there are 22. And
fantastic.
that covers a bunch of different states. I think that, and there's 22 states and 22 Austins. Oh no, maybe not. I think there's more than one Austin in Arkansas, maybe, but it's Arkansas. No, Arkansas has one. Alabama has one. Anyways, I thought that was pretty cool. We're obviously the biggest, the most well-known. And did you know, Kevin, more fun fact part B, the Austin state capital, that's us, right? Our state capital is in Austin, Texas, folks. For those of you who don't know, it's not Dallas. The Austin state capital is actually 14 feet higher than our state capital in Washington, D.C.
Wow.
How you like them apples?
And outside of that, it's the second largest state capital as well. DC is bigger, but it's the second largest in the country.
Everything's bigger in Texas.
That's right.
With that said, thank you so much for tuning into What's Brewing. Each week, I'm joined by my co-host, Mr. Kevin Weedmark.
That's right. Yes.
And we are live. So join us, ask us questions. We are in Ask Me Anything format. Please feel free to reach out, join us anytime.
Absolutely.
Kevin's traveling next week. Where are you going to be traveling, Wilbury?
I'll be in Saratoga, New York. Yeah, I'll be up. You know what? Maybe I'll actually get up and I'll go and sit at Saratoga racetrack and I'll do it from there. I just don't know if the internet's good enough, but that would be cool.
That'd be super cool. We could do a test earlier in the week.
Yeah, I get there Tuesday, so I could test it out on Wednesday real quick and see if I can make that happen. You actually go, they let you in, especially at this hour. Well, yeah, they probably let me in at this hour because I'll be an hour ahead of you now.
Okay. Cooper Goodman is
there he is.
Excited. Come here, buddy. Come on, he's ready.
They typically allow you to go into the park and you can go right up against the rail and you can watch the trainers training the horses.
Wow.
It's wild. They're like, just don't spook the horses. Like don't do anything stupid and we'll let you in. And you just, you just walk in because general admission, I think, starts at like 11 or 12 o'clock.
Oh yeah. So early morning.
Yeah, but you get to go and you just sit there and the sun's coming up and it's phenomenal. So I will try to make that happen, but I'll be there for 2 weeks. So I'll figure out one of those Thursdays. I'll figure it out.
That is awesome. That is awesome. All right. Well, that's it. We're wrapping up for this week's episode of
What's Brewing.
Yeah.
Thanks so much
for tuning in, everyone. We'll catch you next time.
Have a great one. Bye all.
Happy 4th of July.
Yes. Blow shit up.
But not yourself.